Hi, Cherie. Hi, Tamara. Hi, everybody. Thanks so much for joining us. We're going to get started now. We wanted to give you a few minutes to hop on the call. Good evening. Today's webinar, again, just super excited to share some information with you guys with regards to financing. We know that there has been a lot going on in the market. It's been a time of uncertainty in many cases. We've had so many changes, factors affecting the market. So we're going to be going over a lot of information regarding, is it a buyer's market? Is it a seller's market? And then we're going to let Jerome, he's here with us from the Vine Group, and he's going to be discussing some financial strategies, some tips for today's market. Let's go. We're going to introduce ourselves.
Oh, so that was the introduction. My name is Jerome St. I work for Vine Group. Very happy to be able to share this information with you today. There's a lot of stuff that is possible in this real estate world, and we just want to kind of open up your eyes to what can be done with the right people in your corner.
Wonderful. And Max, introduce yourself.
Yeah, Max, I'm a real estate agent for 15 years now. I both sides, live and Zoom, award-winning realtor, teamed up with Stephanie. And we are in a very interesting market. Just happy to share some information and make good choices in the right season for where you're at personally on your real estate or investment journey.
My name is Stephanie, a realtor, and our team, myself and Max, is Stuart Lowe Realty Group. Really passionate about helping folks in real estate, particularly with investing, purchasing properties, focused on building generational wealth, having something to pass on to our children, creating legacy, and changing our lives through one wealth building vehicle, real estate. So I'm here to share. Also, Max and I just had a baby. It's a few weeks old, so that's been a new addition to our daily. What I do is make sure you have the opportunity to take notes, because we're going to, again, just be covering lots of information. We'll invite you to use the chat room. Questions, we ask that you stay on mute so we can get through the information. And at the very end, save about 30 minutes, open discussion, and talk about the market. And again, it's an opportunity for you to share any specifics if you have some questions or scenarios or things that you want to work out and just aren't sure of. Okay, so we'll hop over to the next slide. And Max is going to start for us.
Yeah, so a big question we have right now is, how is the market in Toronto, in the GTA? It's interesting, to say the least. There's a lot of uncertainty, a lot of tariff talk and stuff like that. In the home sales side, total home sales have dropped 23% year over year to 5,600. Average home selling price is 1.1 million, down 4.1% year over year. New listings are at 18,836, and that's up when you have more listings on the market and sales prices are dropping. There's definitely something going on. Inventory right now is historically high. There are way more houses in the market that are selling, contributing to weaker home prices. That means opportunity. So we don't just look at these numbers as doom and gloom. We look at opportunity. When prices are high, that's when you sell. When prices are low, that's when you buy. There's lots of opportunity in the market right now. We'll talk a bit more about that coming up. And when you have creative mortgage options, you have more opportunities. If you see the graph and we break down the type of homes that we have on the market, if the average home price is 1.1, and that's down 5%, single family homes themselves, their average price is 1.2 million. That's down 5.4%. Townhomes, 758K. That's down 5%. Condos, average home price, 593K, down 7.3%. That's the biggest drop out of all of them. So to me, that's the biggest source of opportunity. When you see condos now, before it was buy a condo, assignment sale. Right now, condos and some other properties aren't refinancing and getting the valuation they need. So there's extra inventory. There's lots of opportunity for deals with builders. This is the time to get in and see what you can get. Potentially, if you're looking for an investment property, or you're looking for yourself, we'll say if you're an investment property, maybe you can cash flow now. Before you weren't cash flowing, it was just equity. So there are different options in the market that are available right now as well. Buyers hold the upper hand right now in the real estate market. Is a buyer's market. We are having so many different options when we're working with buyers right now. We can do things like for sale of a buyer's property. So if we're selling a property, we can still buy a property and put a condition that our home has to sell first. When the market is hot, you can't do that. You're getting your mortgage conditions in there. You're getting inspection conditions in there. You're getting price concessions. So there's definitely a lot you can do in the buyer's market. 8% increase in the homes for sale right now. And again, when you have a decline of 23%, it's not even, right? Buyers can negotiate discounts and major concessions. Suburban areas like Carlton and Peel have seen the most significant price drops. In the city center, if you're in downtown Toronto, you can only build so much and it's kind of saturated. So the price is the price. You can't drop that much, but there's some significant price drops. In the suburbs where prices were higher and everybody was moving out to get the deal, they're seeing the most significant price drops. So if you're looking for a townhome or a single or car garage and you're willing to move outside the city center, there's lots of opportunity there. Properties are staying on the market a lot longer. On average, home sales, like you list today, do an open house, and then hold offers till whenever. Now it's accepting all offers and properties on the market for 20 days, 30 days, depending on where you are, a lot longer. So there's lots of bargains to be had. One of the things we look at is, are we in a market crash? I want to think of it more like a market correction. When we're in these opportunities for market correction, we figure it out and make the opportunities happen.
So this is a common question. Is now a good time to buy? As realtors, we get that all the time. Some people will say, oh yeah, you're a realtor, so you're just going to say, yes, now's the time to buy. That's probably true. We believe strongly in the power of real estate and investing in home ownership. But today's market is truly unique. The market trend is that over time, the value of properties go up. In recent years, as Max was going over some of the stats, it's been a very strong seller's market. So buyers really did not have a lot of power. Definitely multiple offers. You're offering over asking price. You're giving up some of your conditions like home inspection or financing, things that were maybe a little scary sometimes, right? You got to kind of take on that risk to get into the property. So it's definitely an interesting time. Now the market has significantly shifted. The power is definitely in the hands of the buyer now. And that is for a lot of different reasons. We had interest rates going up a lot, and that was a big shift that started to affect how buyers we had. It was affecting home prices, and now interest rates have come down. But I think people have still kind of been on the fence. Is now truly a time to get into the market. And also, as Max is going over some of the numbers, you can see how prices have gone down. Market crash, I definitely wouldn't say so. I know there were stories that people were sharing. This house sold $400,000 less than someone purchased a couple of years ago. But I think those are more unique or individual stories rather than truly reflecting what's happening in the market. Prices are certainly down more than they've ever been. The negotiating power is in the hands of a buyer. So is now a time to buy? I would definitely say so. It's hard to predict exactly when is the bottom of the market, but I think we're definitely down there in terms of opportunity, pricing, and negotiating power. The decision between renting and buying a home depends on your financial. Buying now, is it the right time for you? We'd want to, talk to Jerome. We want to get pre-approved to get a good picture of where you stand today. And, there certainly are folks where maybe renting is the best thing for you right now. But knowledge is power, and we want to gain all of that information to see if it is truly that opportune time for you to step forward. A lot of folks have been sitting on the sidelines waiting for the conditions that we see today. The current market presents a unique scenario where sales are slower, homes are sitting on the market longer, and inventory is up. Houses were selling a day or less before. Folks have a chance to look at a house 2 or 3 times before purchasing. There's a lot more in the market for you to choose and decide what's the right property for you. Looking at the average rental amount within the GTA today, it's approximately $2,600 a month, which is 5% down from last year. The average buying price right now in terms of a mortgage is roughly around $2,600 or $2,700 per month. There are a lot of things to consider in the purchase, but I wanted to highlight and thank Jerome for doing this calculation for us. What would that buy you? A rental on average right now, around $2,600 might be a 2-bedroom basement apartment or maybe a 1+ condo. If you're buying, you might be able to afford property at $650K, depending on the market. That's definitely could be a detached property or a townhouse. If you're putting 20% down and that mortgage payment is spread over 3 years, 4.19% interest rate. So again, interest rates are looking quite nice. That's going to give you approximately $2,500 per month. So if we're just looking at what would that dollar amount get you? Definitely buying is looking good. And we know that although properties are certainly appreciating a little bit slower right now, the trend is that over time, properties values go up. So as market continues to shift, you're going to start to gain that equity again and start investing those monthly dollars in yourself and in your family. What we're seeing today is that the costs for renting and buying are very similar. The narrow price gap suggests factors beyond monthly expenses influence the decision. There are other things to consider, like the down payment, your financing. You get a good, affordable mortgage right now. Thinking of maintenance costs and that down payment, your financial situation are the biggest things to have in check before you enter into the market. So is now a time to buy for you? Again, we'd want to look at your current situation and see. So we're looking at your finances. We're also looking at the long-term investment potential. So depending on what your goals are in real estate, are we buying and holding? I think that would definitely be a great option, a great goal, considering what we're seeing in the market today. Your lifestyle preferences, if home ownership is right for you. And then again, market stability. So I would say right now is not the best time if you're trying to do a quick flip, which there was a hot market for that, but I would say that's not really it today because properties are taking longer to sell, right? That's the market that we're in. Buying offers you opportunity to build equity, though slower appreciation right now. You want to gauge how that return on investment is looking for you over time. Renting provide flexibility without the responsibilities of home ownership. If renting is right for you, that's okay. We're here to help you put all the pieces together. The decision should reflect your individual circumstances, financial goals, and long-term goals for you and your family. Hop along to the next one. Thank you so much. I wanted to take a look at the market and not just talk numbers, but also to give you guys some specific examples of what you can buy and where. And again, as realtors, we get this question all the time. There are several cities that offer affordable homes. The first type of home that we're featuring here is like an income property, a multi-generational home, if you will. These homes will offer the opportunity to bring in income, which you can put towards your mortgage. Jerome and I were chatting earlier. There are properties, maybe if it's not a duplex, maybe it's a triplex. You could have the opportunity to live in a home and have your mortgage payment covered. That gives you an opportunity to save, put money towards debt repayment, and just really set yourself up for the future. And we're kind of laughing and saying, okay, like, do you live upstairs in the house? Do you live in the basement? Are you willing to make those sacrifices to get ahead? So this type of property, I love. It's my favorite type of
House hacking.
house hacking. Yes, it's definitely my favorite type of property.
We're house hacking right now.
We are house hacking right now. I think it's just one of the best things. The city areas that offer some of the best ownership opportunities for a property like this, we saw Brampton, Mississauga, Vaughan, Richmond Hill, Kitchener-Waterloo is going to give you great value. When you're looking at these properties, you want to choose areas that offer good public transit. If you're thinking of who you're renting to, the types of amenities that are in the area. Maybe you're not renting, maybe you're doing Airbnb, and there's some really cool things that will attract folks into the area. Look at your potential income. Again, is it an opportunity to pay down towards your mortgage or live for free? So this example here is 45 Highgate Road in Kitchener. It is the property that you see at the top there. Each unit has 3 beds, 3 baths. It's a bungalow style. It's 1,000 to 1,500 square feet. The amenities, it's close to the highway, lots of stores, shopping, movie theater, fitness center.
Thing about this property too is it's kind of on the border of Waterloo. It's on the west side, not too far away from the universities. So you can get a wide range of different types of tenants and good quality tenants. It's a suburban area. It's not really student rental, but you could get educated students with good income, engineers, or you can rent to a family and house hack yourself or to 2 families. It's a really nice area. I like that one.
Great. All the properties we're featuring today are actually on the market. We looked at the numbers, went online, and hand selected these. The property at the bottom is one of our listings, 15 New Hampshire, Brampton. It is a legal duplex, 4 bedrooms upstairs and a 1 plus a den. The market houses like this one in the neighborhood are selling between 1.2, 1.3, depending on upgrades and stuff. So that's just to give an example of what you might see in the market in terms of a duplex. And then I'll show you another option. So Oshawa, which is east of Toronto, is going to offer a lot of affordable properties. The average home price there is about $769,000. The average home price Ajax is $945,000. The average home price in Toronto passed $1 million in 2021. Now it's like 1.1. Average home price in Hamilton, 788,000, and in Kitchener, 771,000. So what we have here is 22 Burtonbury Lane. And this home is on the market for 699,000. It's a townhouse, 3 beds, 3 baths, and it's got 2 parking spaces with a garage. So that property under, well, approximately 700,000. Okay. And then we can go to the next one. This is the third property. The other type of property that you can get in the market is something like an inventory home. These are some new homes. And I know pre-construction has been a bit of a bad word lately because of some of the things that have been happening. There were some issues with the market shift, appraisals and whatnot. But if you're interested in getting a new home, there are still many benefits and a lot of incentives are being offered by builders. Homes at really significant price decreases from pocket listings, which I have here, an assignment sale, a great opportunity to enter the market. If you're doing an inventory home, something that closes within a couple of months, maybe 60, 30 days if you're ready to go, you're not have that issue with the appraisals. There's types of lending, securing the loan and the appraised amount. So you don't have to worry about that. There's strategies to still successfully buy new homes in today's market. Empires of Winfield is townhome projects. They do have detached homes, but the 3 bedrooms are starting from 595,000. We have these private sales, which we call pocket listings or assignment sales. You won't find them online on the MLS system. It's more within realtor networks. So this is an example of one that popped up a couple of days ago. It's a freehold 2-story townhome that's for sale. Originally, the buyer purchased it for 755,000. It is selling for 765. This property is closing in October. At the bottom, you're getting a $5,000 credit for decor. 3 beds, 3 baths, and some other nice features. So a few different types of properties that are available to you guys on the market. I'm going to pass it over to Jerome now. Jerome's going to get into some of the financing, how he's going to help you get into some of those properties that we highlighted. Jerome, you can take it away.
Thank you so much. I liked the presentation and I learned a little bit myself from what you guys were doing. Thank you for that. I didn't realize you guys were house hacking and I'm super jealous. Yeah. I'm in a condo right now, but I've always wanted to house hack. I think that's just the smartest way to move forward and pay down your investment faster. If you were looking for a condo versus looking for a duplex, as long as it has a separate entrance, we can get what's called the fair market rent for how much that unit is able to rent for and add that onto your income, which makes it easier for you to qualify. So that's something I probably would look to do in my future, but not quite yet. Thank you guys for coming. I know some of the people I invited were on Caribbean time, so thank you for making it as well. Let's get started. I wanted to talk to you today about all the different types of financing and all the different types of lending, right? So they've made it very clear that it is a buyer's market. And I know a lot of people have been waiting on the sidelines. When's it going to be a dip? When's there going to be a dip? And here we are. This is the dip we've been waiting for. But it still is difficult, or there still are obstacles to overcome. My job as a mortgage broker is to let you know there are options and solutions for any problems that might arise. The 3 types of lending we're going to today are A lending, B lending, and what I call C lending, which is private equity. The first type is what you're most familiar with. I work with a lot of first-time home buyers, and I also work with a lot of investor clients. And A lenders can be used for both, and B lenders can be used for both. But one isn't necessarily the only option, right? So if you're looking at this now and you're saying, I have great credit, I have low debt, I don't need to know anything else, this is kind of what I wanted to show you, because even if you are an A client, there may be a way to use B lending or even private lending to kind of help with whatever your strategy is in real estate. So lenders, let's start with them. That's going to be your Scotiabank, your TD, your BMO, and a big 5, but there's also credit unions. We have Desjardins, Manulife, as well as monoline lenders. I'll talk about monoline lenders because recently some of my clients were confused thinking that was a B lender, but those are actually A lenders that are just less advertised. They don't have credit cards or lines of credits. They're banks that solely do mortgages. For that reason, you can get discounts there. When I do pre-approvals and you come to me, I'll usually say, okay, this is what Scotiabank's willing to give you. I also have a monoline lender with First National, Lendwise, and this is the rate. So if you're comfortable with them, you might get a discount. If you say, you know what, I've heard of TD, I want to stay with TD, we're fine. But I'd love to give you both options so you can choose yourself. B lenders is what I want to focus this presentation on because a lot of people a little bit less informed, don't know what they can do or how they can be used. They are higher interest rates than the A lenders, and they require a little bit higher of a down payment, but it might be very helpful if you find yourself in a situation where you can use one. They are more flexible. They can help people that have bruised credit. Typically for A lending, they want you between 600 and a 650 credit score. If you're under 650, as long as there's a story, they can make it work. But anything under than that, they're not going to approve you. With a B lender, we can still get you in. Last but not least, if the A lenders don't work and the B lenders don't work, we can get private funding. Those are more unique to your situation. They are by far the most expensive, but if you find a property or situation where you have to close, that would be when we get private funding. So just to let you know, there's options regardless of what you're going through, and we can strategize for you. Why does this matter? The entire landscape is constantly moving. We're all watching the news. It's getting crazy out there. Aside from things happening in the economy, the banks are getting more strict. People that qualified previously on the A side might not. And that has to do with what they're accepting as income, the current rates, which are pretty good right now, but the lending landscape is definitely shifting. What you do for work. They're always changing their policies. Are you a regular employee that gets a paycheck every 2 weeks? Are you self-employed? Self-employed is something we're going to focus on in this presentation because in many situations, it's better for you to be on the B side than the A side, depending on how you're paid. I have an example for that later. Again, if you have any credit concerns as a B lender or a private lender, a lot of times we're going to put you there as a temporary solution to get you back to the A side later, but you're still going to get your foot in the door while we have a buyer's market with this dip. Okay, so just quickly go over some of the reasons currently that A lender might decline you. The first, of course, is credit. You walk into Scotiabank, they say no. You walk out, I can get you with a B lender, no problem. Self-employed income can be hard for them to determine how much you make. So if you have an income that is variable, maybe you're a waiter, you get tips, or maybe you are a salesperson who gets a bonus or a commission structure. A good example is also a realtor, because let's say the year starts, you sell a couple of houses, and then there's a gap between a few months. They don't know how to qualify because they're very black and white for the year. A B lender might look at a little bit more what we call common sense lending and say, okay, you've made this much for the first 6 months. Let's calculate this, multiply it by 2, annualize it over the year. And that's what we're going to use as your income. A situation like that, there's a lot of realtors that might say this is much better for my job to get another property than going to an A bank, which looking at your tax documents. If you have a car lease or a car payment or any high debt products, a lot of times A lenders will decline you. We can get through with B lenders. New to Canada, so if you've just moved here, even if you have very good credit, once you first get to Canada, you have to start over because you have no history, right? They base a lot of your credit on the history you have. And if it's not quite there yet, a B lender is more likely to understand that and say, okay, you only have this because you've been here for so long, and help you get through. And then the last is unique properties. This could be mixed residential, commercial properties. If you live on top of or behind a storefront, these unique properties, cottages, sometimes they're not going to do that on the A side, and you need to go to a B lender. Or if you wanted to get a studio or a bachelor that was under a certain square foot, and they call it a micro condo, a lot of lenders will say no to that, but we can still get you qualified on the B side. And to be honest, that's a good example because right now those are very affordable if you just wanted to get into the market and kind of work your way up. B lenders are not just the plan B. This is really what I wanted to get across because I've had quite a few examples of clients that were able to get with an A lender but chose a B lender. The first reason, like we said, is if you have a lot of debt, it's holding you back, but you want to get in now, we can do a B lender and we can do a 1-year term, get you back to the A lender after 1 year. Again, the unique properties, customized loan terms. On the A side, you can have a loan that's amortized either 25 to 30 years. The difference on the average mortgage between 25 and 30 years is about $400 a month. So that's how much it helps you to extend that over 30 years. B lending can actually get you to extend that over to 40 years. So depending on what your strategy is, you might really want just to have that lowest payment. For example, if you bought a rental property and you had a certain amount of rent and you wanted to keep a certain amount of cash flow, you could say, you know what, give me that 40-year term. I want to keep this as small as possible just so you can have that extra money every month. Accommodating co-signers and guarantors. Income is super useful. A lot of first-time homebuyers are finding out that it's much easier if you have mom or dad or aunt or uncle who can co-sign. They can help you with their income. However, co-signers, it's not the best idea if they have plans to buy real estate in the next little bit because that mortgage they're co-signing for is going to be on their profile and it might hinder them. So that's why they have guarantors. Guarantors allows us to use their full income to help you qualify for what you need, but they're not going to be on title. So stop them from making their next move. That used to be more common 5, 6, 7 years ago, but over the last few years, it's becoming less likely. Banks are saying, no, we want you to be on title. On the B side, I have lenders much more likely to say, oh, we're fine with the guarantor, and it won't hinder that person if they do want to buy an investment property in the future. And the last example is if you wanted more purchasing power. So I'll give you guys a quick story of a client I had recently who was shopping. I was working with their realtor. I did their pre-approval. I gave them the number. They have great credit and they were on the A side. So they were approved for about 600,000 and they were looking, realtor was sending them emails. They were having showings. And whenever they're ready to put an offer in, they would, let's say it was listed at 599, put an offer in at 599 or 549. But what it ended up selling for was either 620, 630, 650 or in the sixes when they were maxed out at 600. This happened a few times and that's kind of common in real estate where it'll be listed for 599, but it will sell for a little bit more. And they were getting kind of discouraged about the process. They really wanted to get in the market now, but they kept getting outbid. So they said, you know what? It looks like it's not the time for us. What we're going to do is we're going to save for the next year or 2 or 3 an extra 20, 30, 40. We'd already done a budget with them as well. And when we get that extra 40 or $50,000 to get to where these are ending up, then we'll come back and we'll buy the house. So the issue with that is waiting a year or 2 years or 3 years in this market. And I know we're in a dip right now, but over time, we are still gradually increasing. By the time you've saved up that money, that property that you saw for 620, 630, 640 would also have increased in what it costs to get into that property. So I said, how about this? You have a great down payment. We'll look at this on a B side. When we do a mortgage application, long story short, how much money is coming into your account versus how much money is coming out of your account every month. And then it spits out a ratio. A lenders might stop you right here, but B lenders will stop you up here. So we redid his numbers for B lenders. And instead of being qualified for 600,000, he was qualified for 700,000. By going to the B lenders, the interest rate is higher. If typically, let's say we're at 4% on an A lender, a B lender is about 1% higher. So 4% for an A lender, 5% for a B lender. And there is a setup fee, but it's only at the start. We calculated the setup fee, but the difference in payments, and it made sense for him to get in the market now. He ended up doing 3 years with the B lender. After that 3 years was done, we put him back on the A side, but he had now grown with that property. So he got in the property that he really wanted. He grew with the market and now that equity was in the property and it's his. So that's an example. And one of the main things that I've seen working for people who just want to qualify for a little bit more. And, you know, the Scotias and the TDs are saying no. I'm saying, no, let's do some calculations if this makes sense for you. And most of the time it does. A next really popular, and this might be the best example for when you need to use B lending is if you are self-employed. Because like we had the example earlier, if you have variable income, it's very hard for A lenders that are very black and white to say what you make if you have your own business. If you're self-employed and you use a B lender, it's a little bit more flexible for how they verify your income. They use common sense lending and can annualize if you have anything that comes in at different times. They can tailor mortgage products to you. And even if your credit is below a certain number, that's okay as long as they can see the money coming in. The main reason I would say is for tax savings and strategizing. I'll give you another story. Switching. Oh, there you go. So these are the numbers. I'll tell you the story. This is another example. And to be honest, I've had this question quite a few times over my career for people that own their own business. And it's becoming more important because if you look at the landscape and maybe you want to start your own business or you know someone who's starting their own business, it's becoming more popular for people or there's just more self-employed people these days and it's constantly going upwards. I think this is going to be big in the future. And basically, when you are a business, it's not about how much money you make, it's about how much money you keep. And that gets drilled into my head by my accountant every year. A lot of people that are self-employed make a certain amount. For this example, this client of mine, 125,000. However, every year when he did his taxes, he only claims about 50,000. That way you're saving on taxes because you get to leave the rest of the money in your business account and you're not charged the taxes on it. He called me, said, hey, I'm looking at the market and I'm ready to move. I'm about to do my taxes. Do you think I should claim what I make, which is 125,000, so that I can get approved for more? This is someone who's thinking because they're aware of how lenders qualify you. And that's with your tax documents. They're going to look at your T4s. They might look at your T, but they're not looking at how much money you bring in. They're looking at how much you claim. That doesn't work for two reasons. First, if you increase your money, it's going to be a lot of money in taxes. At the 125,000 mark here in Ontario, you'd pay $37,000. Second, they need a 2-year history. So even if you were to go to your accountant and say, I want to claim the full 125, they're going to say you made 50,000 last year. We have to average that out. So it almost cuts it in half to what you'd be approved for on the A side. So instead of doing that, I said, listen, we're going to save you a lot of money. The actual difference was 25,000. By claiming what you normally do, 50,000, now your taxes are only 11,000. You've already saved 25,000 off the bat. And the interest rate is going to be negligible. At the top here, you can see on the A rate, now average would be 4.29. We got you the same exact mortgage with a B lender that's 5.19. There is a fee, but it was a couple thousand versus the 37,000 you were saving. And the difference is they're not looking at how much you claim, they're looking at how much you make. So an easy example is if you have a retail business, you buy and sell things, they're going to say, give us 12 months of your business bank statement. They're going to add every sale you had over those 12 months. You had $130,000 worth of sales. Then they're going to say, tell us how much your expenses were. So they want to know reasonably what your expenses are. Let's say you had 5,000 in expenses to make that 125. And they take that away from the 30 and they say, okay, your income's 125,000. Now you can qualify for that place. You didn't have to pay any additional money. You've just saved yourself 20 and you're going to get that exact same property. So this is something that I really want to get out. Thanks, Max and Stephanie, for allowing me to tell your audience this, because so many people aren't aware, whether they are self-employed or about to be, or on the fence and they want to start their own business, but want to buy property soon, they might hold off. So we just want to let you know that's not the case. And there are those options for you. So that was lending, be lending for clients. And then the last option is private. So there is a space for this as well. Short-term financing, if there's any last-minute deals, equity lending, if you were to lose a job and you have a really nice property, they can lend you money based on the property. If you have bad credit history, even bankruptcy, and you need to wait that time, we can get a private. They can do blanket loans and mortgage if you have more than one property, and they put the mortgage across multiple properties for you. If you wanted to do debt consolidation, private lenders are great for that. Any investments or flipping, I know they said it's not a good time for it, but when that becomes favorable again, private lenders some of them are specifically built just for people that flip properties. The real need for private funding is a worst case scenario. It is the most expensive of the three. But another story I had is if someone were to lose a job. I had a client, they bought a house, husband and wife, both great incomes, and it had to close 60 to 90 days from the day they bought it. 30 days from then, the wife lost her job and the lender had not completed their file yet. So they were kind of freaking out. What do? We no longer qualify for this. They've already waived conditions. Had they not had a private solution, they would be on the hook for the deposit, which can be $20,000 to $30,000, and then not get the house. This is where private lending comes into play. They're very quick. Some private loans you can get done in a week or two. You get an appraisal. Another thing about private lending is they're more concerned about the property, that there's equity, than the profile of the person. Typically, it's going to be a temporary solution. So whether that's 6 months or a year, and then during that time, she started interviewing. She got another job fairly quickly. We were able to bring them back to the A side. No harm, no foul. So just to show you that there's a need for every type of financing, depending what the issue is. Pre-construction, and Stephanie's touched on pre-constructions as well. There's a need for everything. Pre-constructions are really good, especially if you want to save more for down payments. But as we know, recently, values are down. I still believe values are up over a 10-year span, but the market goes like this, right? So depending where you land, when the builder calls you and say, hey, we're ready, you might be in a dip. And what we were seeing was some people were finding that when they had to put a mortgage on the file, the appraisals were coming back low. So if you're coming back low on an appraisal, you have to come up with a difference in money. And that was causing a lot of people to panic. Depending on where you are in life, you might buy a pre-construction today that doesn't close for 4 or 5 years. Maybe you no longer live there. Things have changed in your life. What do you do? So we had a lot of success with these actually that are like, you know what, we've already been paying into this. We've already made a little bit. We just want to sell this property, but you still need to close with the builder. So private lenders will give you that solution where it's like, okay, we're willing to close for you. We'll give you a 6-month open term. So if you don't want this property anymore, you want to put it back on the market, even give it back to Stephanie or Max to find you a new buyer. We're going to close so you can walk away from the builder. And now it's going to be open for 6 months. What that means is now when you sell your property, there's not going to be any penalty. If you were to go with a closed term with a lender or B lender, you have to pay a penalty. but you're just literally closing so that you can sell again and recoup your investment money. So
That's a great option. Not a lot of times people have options in the tool belt where you might close and put a tenant in there if you can. You might close and do whatever. But instead of just walking away and losing your money, you have an option to do something. And if you know that you can write it out, if you have good planning and strategies, you
yes.
definitely can save yourself a lot of pain.
Exactly. Because it all happened at once, there is the option to sell an assignment. But when this started happening, the whole market values were down. So when people were just thinking, oh, I'll just sell an assignment, and they would try that, there were another 10 people saying that, which then flooded the assignment market. So then there people were like, I thought I was going to make an assignment. It's like, no, let's close this and then sell it. So it worked in that way as well. But again, it's just about having these options so you're not stuck here or there. To compare B lending and private lending, these options require a higher down payment than A lenders, but they're going to be much more flexible. Interest rates on the B lenders are about 1% higher than the lender. Privates can be anywhere from to 12%, depending on the type of property. The approval for B lenders is a couple of days to a couple of weeks, similar to the A side. But because private lending is ready for emergencies, you could get something done with 24 to 48 hours if you really needed to. I would say more common is a week or two to get those done. They're more willing to accept risks on the private side, moderate risk for the B lenders. B lenders also are regulated by traditional banking rules. Privates are not. There's investors that are pooling their funds to then issue out these private loans. The collateral documents often required, but more flexible in the A lenders for the B lenders, and again, more flexible for privates. Okay, so this is a very important slide. The power of choosing your realtor is extremely important. And I've been following both Max and Stephanie for years. They know what they're talking about. I was impressed today just on their slides because they were all the way from Kitchener out to Oshawa. A lot of my clients are in the East End. I didn't know if you would go all the way over there. But if you are looking for someone to find you a property, they're willing to go anywhere. That's amazing. There's so many people out there that don't know the advantage of having B lenders or private lenders because they don't have realtors that are willing to give you this information and put me in front of you to say that. I heard her say for a second, you can rent. If renting's for you, keep renting until you're ready to go. You don't want someone that's going to pressure you, that's going to be on your back. They're just here to give you that advice. And I think that speaks highly for them. So super important to pick your realtor wisely. And that's all I have for this one. That's it. No problem.
Okay. Great. We did really great. We wanted to have that hour to go through the slides, so we're right on time.
I went over time. Sorry.
We're
Knew
good.
this would happen.
You're great.
Everything else was for questions. And go other job.
So we're going to open up the floor for everybody to ask their questions, share any personal situations or things you saw, comments and headlines that you've seen. We're going to open it up to talk and share. I just want to say again, thanks to everybody for joining us, and a big thank you to Jerome for all that amazing knowledge you shared. I'm going to highlight a few things during the discussion, but it was really great.
Yes, thank you so much. Information. I'm always learning something, and having great guests like you and working with agents and mortgage agents like you as well to give good service. Thank you.
Thanks. Thank you so much. Thanks for having me.
Yes, thank you so much. Feel free, guys, if you want to unmute, if you have any questions, we'd love to hear your thoughts, or if there's anything that stood out that you learned today that you want to highlight and share as well. That'd be great.
Thank you, Tamara.
Thanks, Martha.
I have a question. I'm not very familiar with the whole real estate thing, but switching from B lenders to an A lender after 1 year, why does that take place? How is that a thing? What are the terms of these types of things usually? Dumb that down for me.
No problem. And that's a great question. Since you're not familiar with the real estate thing, I'll tell you from A to, even if we were to put you with an A lender, your term is typically going to be from 3 to 5 years. At the end of those 3 or 5 years, that's your maturity date. You can switch from any A lender to any A lender without penalty. A lot of times, this is when we can get banks to compete for your business. So you might start with Scotia, and then at the end of the year, they're going to say, we can renew you for this amount. TD is going to say, it's kind of like Rogers and Bell, how they're constantly fighting for your business. If you switch, you might get a deal. So the same for B lending. We would just wait for that maturity date. And 3 to 4 months ahead, we would do another pre-approval, make sure you can qualify. A lot of times what I've found is over the 5 years, employees maybe make a little bit more income. They also have 5 years of their mortgage paid down. So a lot of times it's a little bit easier to qualify the second time around than it is the first time. But we would set you up 3 to 4 months ahead of time so that on that day, the new bank pays out the old bank, and then we can get you to the A lender with those terms.
That makes sense. Thank you.
No problem.
Great. Thanks.
Good question. by the
Question.
way.
Thanks for the answer.
Anyone else have any questions? All right. One thing I wanted to highlight, Jerome, I loved the information you shared for those who are self-employed, that tax saving strategy. I think you explained it really well. It's something that a lot of folks kind of struggle with. Understanding the way that you laid it out, it was really helpful. It's a really important piece of information to understand and use towards your advantage to save overall. Sometimes folks get caught up on that interest rate. I want the best rate, but don't
Mhm.
really take into account all of the other factors that play into qualifying and savings versus costs.
Yeah, one thing, Jerome, you'll probably can attest to is I like to look at mortgages as products. What product serves me right now? Like
Yes.
for what my plan is and my strategy, what lender I'm in right now, what product is best, right? So it may be the A lender, the B lender, or this A lender, some A lender. If you're investing, they only do X amount of properties. Does 4 or 5, right? And that's the product that they have. Another will have a different product that suits you for just a private loan. Not always about the interest rate.
Sure.
Do you have any suggestions or strategies for folks who own a property now and are looking to maybe transition? I know someone on the call had some questions about that. How to
Mhm.
utilize some of the equity maybe from their properties.
That's a great question. I actually have an entire presentation on that alone. If you have a question on that, I would love to talk to you more later. Long story short, try to use your equity before using your own money. If you are an investor, you have your property, you're paying it down, and then on the side, you have some savings. A lot of people will save and then say, okay, I have this amount of down payment. I can buy my next property. It's not what you make, it's what you keep. So there's a tax strategy where instead of using your own money, we're going to refinance your property. We're going to refinance it enough to pay out the first mortgage and then put another mortgage on top of it that is just the equity takeout. We're going to use that as the down payment for your investment property. So what that would look like is we're going to get you a $500,000 mortgage. 400,000 is the old mortgage. 100,000 is the equity that we're going to use for the down payment. We're going to go to a lender that lets you split the mortgage in two like that. This makes it very easy for your account to see that 100,000 you took out for the down payment is now tax deductible. Right. So instead of using your own 100,000 where that would just disappear, now you're going to have every single year that 100,000, the interest that accumulates on it is going to be tax free. So there are tax strategies by using your property and refinancing your equity. And you can do that even if you had savings, add that on top of it so you have a larger down payment. But definitely there's an order you can do that will save you some money every year around your tax returns.
Yeah, I love the tax strategies.
And one of the groups that I didn't see on there, we should have put on there. We encounter everything on both sides, mortgage and the sales side. You could be going through a divorce. And when you're coming out of divorce, you're looking to, are you going to rent again? Are you going to buy again? Can you qualify on your own income? Right. So it's another great strategy and option to check into to get back into a home. You have kids involved. It's a fact of life. It happens. And it's another great option that you look at. I don't have a story for that, but that's definitely another group that would use alternative lending.
We do that as well, unfortunately. But if there is a spouse buyout that involves a refinance, I actually did one recently, and we can look at if you can qualify for the house by yourself, right? Because that's the main question. We have to split this asset out. Who's going to buy who out? And can the other person qualify for this mortgage on their own? Similar to a pre-approval process, I collect your documents, qualify your income, and see if your mortgage plus how much you need to pay the other person out, you can still qualify by yourself. If you let the banks know you're going through a separation, they will require a separation agreement because that's going to have the terms of how much that buyout is, just so you know.
And what some lenders also accept as income is support payments, depending on household or child support. So there's definitely options when you look at that. We have a good question. You may have some information or programs. We haven't spoken about it yet, but the rent to own and buy with zero down, does that still exist? I'm going to give my personal advice, having done rent to owns and worked with some other companies or agents that have done rent to own, is always be very careful of zero down, because the whole point of rent to own usually is, so a C lender, you're really close to getting a conventional mortgage and it's supposed to be short term. If you don't have a down payment, you have to build a down payment somehow. Your lease option add on to your rent payment is going to be so high that you can't afford to buy out the house and build a down payment. That's one of the riskiest things about rent to own. We usually try to have very close to, if not already, 5 to 10% down. If you're not close to 5% down and can't refix your credit and your situation to get to a CB or a lender later on, zero down is probably not work.
I 100% agree. And I would say that one rent to own program can be completely different from another. It's similar to private loans where these are investors and they have to make money themselves. So you just need to see what the terms are and have someone review them with you. Because much like Max said, you can have a rent to own where they're like, okay, we're going to make a plan for you. You have the 5 to 10%. After 5 years, you should have that 20%. Maybe you need that for a B lender. Maybe you need that for the 30-year amortization. But there are people that will offer a rent to own program knowing you're never going to accumulate enough to own for yourself. And they want you to be there forever. That's the unfortunate thing. Exactly.
Yeah.
I agree 100%. So yeah, I mean, review those terms. I would be wary if they said 0% down as well, because how long is it going to take you to accumulate that down payment while the interest, et cetera?
What I can say is if you are interested in rent to own and do have a down payment, I will want more information or have approached one, give me a call. I'm familiar with them. I've done them and I know how to navigate that. I can give you some advice, seek a lawyer's advice, but I can give you some general real estate advice and experience. And if you're interested in being an investor for rent to own, that might be something that we do later on. Again, give me a call. And basically it's matching the right investor, the right rent to own tenant, because it's supposed to be a win-win situation. And we usually do it with mortgage agents. And that way we have the process set up where the tenant, the investor, and the mortgage agent, it's a seamless process, coach you and work with you all the way through the process, because we don't want you to lose your deposits, your monthly deposits or your major deposit. And we don't want to lose a good tenant or get a bad name. If you want more information, definitely give us a call. If that's what you like, put it in the group, reach out to us, let us know the different topics you like, and we'll do some information on that.
Yeah, I just say I know that we're at the 30 time mark. So if anybody has to jump off, thank you so much for being here. Please let us know what topics you might want to hear in our upcoming webinars. We're here to support you to help make your dreams a reality. So if you do have to go, you can go ahead. Definitely connect with Jerome. He's got a lot of great information. He's really here for you. I definitely noticed that, and really happy to have the opportunity to have you here again, Jerome.
Thank you. Who left
Sharing
the
that.
record had to be.
We're going to hang out.
We're still here.
We're still here. We're going to hang out a little bit longer and you guys can continue to ask questions. I just wanted to officially say if you had to go, we appreciate you. Does anybody else have any other questions, thoughts, anything that stuck out to you today? Any questions about the market? I hope we covered that well for you. I know there's been so much going on. Jerome, based on that last question, do you see 0% downs? Does that really truly exist? I know some folks said it exists in the US, but not really in Canada.
I hear more in the US. And I remember people always saying, I saw 0% down. And I'm like, is it America or Canada? I have seen rent to own programs, some that were good and some that weren't so good, but I don't see much of the 0% down payment. How about you guys? You come across any?
Prices are too high in Canada. So you can start off with a $300,000 home somewhere in the States, in the South or wherever, and 0% down, whatever your mortgage is, you can add on a deposit eventually. But if your average home price is 1.2 mil.
Exactly. Because I mean, you're at a starting point, starting from zero, trying to accumulate all the way to what you need would take a very long time, I'd imagine.
You guys okay if I touch on that?
Yes, sure.
Okay, so one thing I could tell you is that was an old strategy in Canada, maybe 18, 20 years ago. That doesn't exist in Canada anymore. I'm a fellow mortgage broker, so you guys know me. I'm just listening at what's going on. It does exist in the US, and zero down doesn't mean that there's no money down. You could use zero down of somebody else's money, not your money. And it's an investment strategy that works in the US. It doesn't work here. I'm not saying it's impossible, but there's certain things that we need to do here in order to have that strategy work from an investment standpoint. There's no such thing as zero down in Canada. Thanks to the politicians we elected to make the rules, they make it difficult for the average person to get into the market, but it doesn't exist.
Yeah, we haven't really seen it like that. But 10 years ago, prices were different in Canada too, right?
Yes, but there are strategies from an investment standpoint. But
Yeah.
just for a regular person to get in and buy a house, no, it's not going to work.
Yeah. And that was more so for rent to own, but definitely we get, thank you.
All right, guys. Last call. Last question.
Last call. Great.
Hmm. So if that is it, definitely grab our contact information here. Reach out to us if you have any questions about properties you've seen on the market, some of those areas that we suggest where to buy and what's going on. We're here to support you, Jerome, here, of course, to help with financing. Any questions you have, make sure you connect and reach out to him. Jerome, anything else you want to say as we wrap?
I had a great time doing this. We should do it again. And it looks like we had a good few people in here. So thank you for having me. Thank you for all the information.
Yes.
Great.
Thank you.
Thanks again to you guys for your participation, your questions, and your presence here. We appreciate you. And
Sure.
we'll see you guys.
Thank you.
Thanks.